Welcome to the Deep Dive. Today we're plunging into the latest earnings call from Affirm Holdings Inc. That's ticker AFRM. Now, this is a company, really at the heart of the buy now, pay later BNPL revolution. But lately, the big question I think on everyone's mind has been, can a BNPL company really achieve sustainable profitability, especially now? Affirm's Q4 fiscal 25 results seem to shout yes, and we're here to unpack the strategy, the tech, what made it happen.
Yeah, it was a pretty remarkable quarter. Affirm definitely delivered results that, well, the market certainly liked, marked a real turning point.
Absolutely stellar is how I'd put it.
For sure. So for Q4 FY25, Affirm reported GAAP EPS of $0.20. That's generally accepted accounting principles, earnings per share. And that easily beat the consensus estimate, which was around 11 cents.
Big beat there.
Yeah. And revenue also came in strong, $876 million. That's up 33% year over year. Again, topping the consensus, which was about $837 million.
And gross merchandise volume, GMV.
Oh, record territory, $10.4 billion. That's a jump of 43% year over year. Huge volume going through the platform.
But the headline, I think, the one that really changes the game here, their first quarter of operating income profitability as a public company, that's massive.
Absolutely. That's the critical inflection point, isn't it? Moving from just growth to, well, profitable scale. And, beyond those headline numbers, other metrics looked really solid too.
Like what?
Well, Affirm Card revenue hit about $67.1 million. Transaction volumes there just soared, up 102% year over year.
Wow, 132%.
Yeah. Active consumers grew 24% to 23 million people. Their merchant network also expanded by 24%.
Yeah.
And transactions per active consumer up 20%. People are using it more often. Oh, and management expects their RLTC, this revenue less transaction costs, take rate, to run at the high end of their 3-4% target range.
Right. And RLTC, just to remind folks, that's basically what Affirm actually keeps after paying their funding partners and covering transaction costs. So a higher rate there is really good for their bottom line.
Exactly. Signals stronger underlying profitability.
Okay, let's unpack the strategies, the innovations driving this. It feels like Affirm is firing on all cylinders, kind of a dual growth engine maybe. Where should we start?
That's a good way to put it.
Yeah.
And yet one of the primary drivers and really a key differentiator for them is their 0% AQR plans. These aren't just nice offers for consumers. They're strategically merchant funded.
Meaning the merchant pays the interest cost, not the consumer, and not Affirm either.
Precisely. So Affirm stays profitable, even offering zero interest to the shopper. And Max Levchin, the CEO, he really hammered this point home. He called them real zeros. No deferred interest, no hidden fees.
Which is a big deal, right? Unlike some deals where if you slip up, suddenly all this back interest hits you.
Exactly. Affirm's zero means zero. That builds trust, avoids those nasty surprises. He also made that pretty bold statement, didn't he? Underwriting is hard, and we're good at it, and others aren't.
Yeah, really underscoring their proprietary credit models. Confident claim, but I guess the numbers kind of back it up right now.
Seems that way.
And it's not just grabbing new users, though they're doing that incredibly fast. I saw monthly 0% loans grew over 90% year over year. That's huge acquisition. But, for the long term, does that initial free offer actually lead somewhere? Are these zero APR customers turning into more profitable interest-bearing users later on?
That's the fascinating part.
Yeah.
Yes, apparently these zero users flip over to interest-bearing. So it's not just about volume up front. It's a sophisticated play, really.
Yeah.
They use the 0% as a high-conversion, low-risk way to get customers in the door.
Okay.
Then, once a firm has that repayment history, those customers are much more likely to use Affirm again, maybe for bigger purchases that do carry interest. So they're essentially turning that initial marketing cost, the merchant bidding for the 0%, to a long-term profitable relationship. It's clever. They leverage the data.
Right, cross-selling based on proven good behavior. Smart. But let's shift gears slightly. Something else management was clearly thrilled about. The Affirm Card. I think the phrase was kicking ass and taking names. That definitely catches your ear.
Huh? Yeah, you don't often hear that on an earnings call, but it speaks volumes. The Affirm Card is definitely a critical piece of their strategy now. It brought in about $67.1 million in revenue, like I mentioned, and those volumes exploding 132% year over year.
So what's the goal with the card? Just make Affirm available everywhere?
Pretty much. It's designed to boost how often people use Affirm and, crucially, reduce their reliance on any single merchant partner. Instead of just seeing Affirm at checkout online, the card makes it, top of wallet for everyday stuff.
Okay.
Current GMV per cardholder, trailing 12 months, is around $4,700. But they have big ambitions. aiming for 10 million active cardholders and over $7,500 GMV per year. They're pouring investment into more features. They see that 0% APR feature on the card where you can apply it after a purchase as a sort of surprise and delight thing.
Ah, interesting. So it drives engagement.
Exactly. Makes it sticky. It's like having BNPL right in your physical or digital wallet, ready to go anywhere.
These growth numbers are definitely impressive. But, any lending business lives and dies by its foundation, credit quality and funding. How's Affirm holding up there, especially with, all the economic chatter?
Yeah, you hit the nail on the head. That's the bedrock. Affirm considers credit quality job number one. That's the quote. And they reported stable credit performance. Actually, 30-plus days past due improved quarter over quarter.
Improved? That's counterintuitive maybe for some.
Well, their approach is disciplined. They underwrite every single transaction. They're not afraid to say no if a loan looks too risky. Combine that with the short duration of their loans and the fact that 95% of transactions come from repeat borrowers.
95%? Wow.
Yeah, huge repeat usage. That lets them focus intensely on someone's current ability to repay. They've also apparently taken steps to mitigate risks from things like student loan repayments starting up again.
That disciplined approach is definitely key. But, no model's perfect, right? What are the potential weak spots? Could a sharp downturn still hurt them, even with transaction-level underwriting?
Well, that's always the question, isn't it? A severe sudden economic shock could test any lender, absolutely. No one's immune. But a firm's ability to underwrite each time someone transacts, rather than just giving a big pre-approved credit line, does give them more levers to pull in real time. They can tighten or loosen criteria very quickly.
More dynamic risk management, huh?
Yeah, helps mitigate some of those broader macro risks, in theory.
And what about funding? Do they have the capital lined up to keep fueling this growth?
Seems like it. The funding environment sounds very favorable for them right now. Management described capital markets as wide open. Their fund capacity is up about 55% year over year, but interestingly, their utilization of that capacity is down.
Meaning they have plenty of dry powder.
Exactly. Lots of room. And they're being selective too, apparently. Prioritizing long-term deals with blue-chip asset managers like Sixth Street, not just chasing the absolute lowest cost. On interest rates, they gave some color too. Said a 1-point move in reference rates translates to maybe a 40 basis point change in their funding costs.
Okay, manageable.
And there's a time lag too, like a year or two for the full impact. So they have time to adjust pricing or strategy.
So pulling this together, what does it mean for their overall strategy, their ecosystem? We did hear about the direct Walmart integration ending. That felt like a big deal partnership-wise. How do they fill that potential gap?
Yeah, management confirmed that. The direct Walmart deal is ending, expected to be fully wound down by the end of Q1 fiscal 26.
Right.
And while, yes, that was a notable partnership, they seem confident they can offset it.
How?
Through growth in their direct-to-consumer channels, so their own app and website primarily. Plus, continued Affirm card adoption and strengthening other big partnerships like Amazon and Shopify.
Diversification then. Don't rely on any one channel.
Exactly. And they're also making big strides in integrating with payment service providers, PSPs. Think Stripe Terminal, for instance. This unlocks offline in-person retail. That's potentially huge.
Right. The greenfield opportunity you mentioned earlier.
Yeah, they described it as a green field. And when you think about it, offline retail is roughly, 10 times the size of e-commerce. It's a massive potential expansion for BNPL if they can crack it smoothly at the point of sale.
Makes sense. What about going beyond North America? Any international plans brewing? Because that's a whole different ballgame, right?
It is, absolutely. And they're approaching it cautiously, methodically. They are actively pursuing it, starting with friends and family testing in the UK, partnering with Shopify there initially. Europe seems like the next logical step. Their core platform is built to be reused, which helps, but
local rules, data, licenses.
Exactly. All that requires specific country-by-country work. It's not just flipping a switch. Their plan seems to be leveraging existing multinational partners, ones who are already happy with Affirm in North America, to help ease their entry. It reduces the need for huge, splashy brand investments in new markets.
Okay, a partner-led approach internationally. And one last piece. AI. Everyone talks about AI. How is Affirm actually using it?
Yeah, it's not just talk for them, it seems. Their adaptive checkout feature is powered by something they call Adapt AI. It's their internal AI machine learning system that optimizes the financing offers shown to each individual consumer right at the moment they're checking out.
So better personalization, better conversion.
That's the idea. Early results apparently show an average 5% lift in GMV just from this AI optimization, which is pretty significant.
Yeah.
And looking further out, they're thinking about agentic commerce.
AI assistants doing the shopping for us.
Basically, yeah.
Yeah.
They see this as a fundamental remixing of e-commerce. And in that world, embedded payment solutions like Affirm, already integrated, could become even more important. The AI agent handles the purchase, Affirm handles the payment seamlessly, could drive volume for merchants. It positions them well for whatever comes next in digital commerce.
Very interesting. And looking ahead, they also gave some pretty strong guidance, didn't they? Shows confidence.
They did. For Q1 fiscal 26, they're projecting revenue between $855 and $885 million and GMV between $10.1 and $10.4 billion. And for the full fiscal year 26, GMV is expected to be at least $46 billion. As management put it, the whole narrative is shifting now. It's not, can BNPL scale profitably anywhere? They feel they've answered that. Now it's, can profitable scale persist through competition and mix changes?
A more mature phase focusing on sustainability. Okay.
Yeah.
So what does this all mean for you, the investor, tracking this space? I mean, Affirm stock has certainly done well recently, outpacing the broader market like the SPY and even the Phoenix FinTech ETF.
Yeah, that outperformance definitely got noticed. The focus on Wall Street now seems to be on, one, can they sustain that 0% APR mix profitably? And two, how well do they navigate these partner transitions, like the Walmart line down? But management keeps pointing back to their strong direct-to-consumer growth, the Affirm Card momentum, and their discipline around RLTC as the key levers to manage those things. It's about having multiple engines.
Right. So looking forward, the big test will be the upcoming holiday season, won't it? We'll see how their RLTC holds up, card usage, and of course, any shifts in delinquency trends. Can they keep this profitable growth going with all the competition?
That'll be the key period to watch, for sure.
Okay, and now for our This Is Not Financial Advice segment, time for an outrageous but maybe plausible trade idea, think hedge fund pitch meeting style.
All right, consider this. A long position in Affirm, ticker AFRM, paired with a short position in a basket of, say, other publicly traded fintechs or maybe pure play BNPL companies that seem more focused on that growth at all costs model, or maybe rely on less sophisticated underwriting.
Okay, the thesis.
The thinking is, Affirm's disciplined approach, especially with those merchant-funded real zeros, combined with their advanced underwriting that Adapt AI we talked about, sets them up to gain market share and sustain profitable scale. So even as competition heats up, or if credit conditions get tighter for lenders who maybe aren't as careful, Affirm's operational rigor, something Lepchin really emphasizes, could differentiate them. It's basically a bet that their math and discipline win out over competitors whose 0% offers might not be built on the same solid foundation.
A bet on quality and smart underwriting in the BNPL space. Interesting. Well, what an incredible quarter for Affirm. Really feels like a milestone moment, proving out that path to profitable scale. They've shown strong, diversified growth with the 0% plans and the Affirm Card, all backed by what seems like robust AI-driven underwriting and a clear strategic vision.
Indeed. And that shift in narrative from achieving profitable scale to sustaining it through competition and mix changes, that's really paramount now. Their focus on diversified growth, tight credit control, and AI innovation, those will be absolutely key going forward in this fast-moving consumer finance world.
Absolutely. And as always, remember, this information is just for educational purposes. It is definitely not financial advice. Please do your own research and due diligence. And for a final provocative thought to leave you with, thinking about Affirm's Tech Adapt AI, their underwriting models, could these become a competitive advantage that goes beyond just financing? Could they transform Affirm into a broader commerce enablement platform, especially as things like agentic commerce take hold? Something to chew on. We'd love to hear your thoughts.